I was going to dub this a Twin Peaks world, but I wasn't sure everyone would get the 1990s TV reference, so I've dubbed it a bifocal world. And what I think, why are we talking about bifocal? Well, there's two sort of twin peaks in the market we're seeing right now. One is in large caps, and we'll talk about that in a second. And the second is in certain subsectors of small caps. We're seeing a flocking of investor money to some subsectors of small caps that we think has definitely shown signs of being overcrowded. Now, Matt and I like to sort of frame our discussions with a quote from someone articulate and intelligent, someone like Warren Buffett. And in last year's shareholder notice, he published, well, this is actually a summary of the quote he said, but he said, "Nothing sedates rationality like large doses of effortless money." So think the money printing we had during COVID. After a heady experience of that kind, people drift into behavior akin to that of Cinderella at the ball. And we definitely think we're seeing this now in small caps. And they know that overstaying the festivities will eventually bring on pumpkins and mice. But everyone wants to hang around to the very end of that, and they think they can jump out before the clock hits 12. So thanks, Warren. Thanks for that great quote. And so I think let's summarize the current market environment we're seeing in small caps. It's pretty clear to us that economic sensitivity is played out in small caps. Earnings multiples have been compressed. The companies are more sensitive than large caps. They're less diversified, and so they tend to react more to high rates. Inflation's been hurting smalls, and I like to think that in Australia we haven't seen many cycles. So I lived in London for many years, and one thing that struck me about the UK compared to Australia was just how much more cyclical the economy was. Like in down times, people got sacked. The economy had much more swings. Property prices dropped more. Depression was much more rampant. Australia is such a great place. You can always go to the beach. So comparatively, our cycles are less. But and I don't think our management teams in Australia really know how to deal with inflation very well. So we've had inflation, weak environment with weak headline numbers, strong inflation, and I don't think small cap managers or CEOs have known how to cut costs properly and deal with that. So it's really hurt smalls versus large. However, rates do seem to have peaked. Looking around the world, there's what I call the cut club. So most of the large economies in the north have cut rates. The EU, UK, Canada, Sweden, etc., and even New Zealand, believe it or not, have managed to cut interest rates. And then there's the yet to cut club, which is Australia and the US. So investors have flocked in that environment to large cap, liquid defensive names. And within small caps, the second peak has been earnings certainty stories. So think SaaS technology names, AI, high growth names. People have paid any price not to own a downgrade story. But that's left opportunities in more cyclical sectors, in smalls and micro caps in particular. And of course, in smalls, backstops do exist via M&A, takeovers and private equity, and they are particularly attracted to cash flow style businesses. Just put that into a graphic picture for you. This goes back 2.5 years. The black line there shows the Australian large cap index compared to the mids, which is orange, and then small, which is blue, and then micros, which is green. So literally, as you go down the spectrum in terms of market cap, the underperformance has been bigger. And it won't surprise you to hear that our view on micros and smalls, there's much more opportunity in that subset than there is in large caps. And that's a very long period of time for large caps to dominate versus smalls. Over time, there's been gaps closing up. 2.5 years is a very long period for smalls to lag their larger peers. And it won't surprise you to notice that if you zoom out and do a valuation comparison, this is actually a global chart rather than domestic, I just hasten to add. But if you look at EV to EBIT multiples of the large caps globally and compare that to small caps and the relative valuations, you'll see that this is a 15-year chart. On that basis, the valuation relativities are showing screaming buy opportunity for smalls versus large. It's a bit hard to get the same graph domestically because our small cap universe has some loss makers in there, so the EV numbers don't play out quite as nicely, so we jump to the global to give you a good sense of what's happening in the world. I mentioned rates before and inflation, and in our lead commentary from Jed and Adam, they're talking about when rates get cut, small caps tend to do better. This is a very long chart showing interest rates in the US and comparing to the global small and large cap relativity. So what all this is really showing you is that index, that line going up to the right, is basically smalls outperforming large caps over time. And when that line declines, it's when smalls underperform large cap. And you can see the three areas we've highlighted there in red sort of dots. Basically, after we had a major boom during the dot-com bubble, we cut rates. Small caps sold off into that crisis, and they recovered aggressively as rates were cut. Same thing in the GFC. Small caps had a bit of a blip into that crisis again. People fled to defensive names, and then rates got cut, and small caps had a long period of outperformance. And what's interesting about this chart is if rates are stable, so you can see that period between 2009 and 2017, rates were kind of stable-ish. Smalls drifted higher than large. They actually outperform large. So in rate flat environments or rate decreasing environments, you see small caps typically outperforming the large cap peers. This just zooms in on some of those particular timeframes again, the dot-com, the GFC, and obviously COVID, where in each of those cases you saw rate cutting environments being very positive for small caps. That sounds very interesting, Marcus. Thank you. You'll have your own views for interest cuts, but why then, if you think rates are going to be cut and you want to buy small caps, why would you buy Spheria as opposed to the other capable small cap managers around? And I think we basically claim to focus on fundamentals. Some of our peers are excellent at picking momentum stocks. They think there can be Cinderellas at the ball and duck out at 59 seconds before everything crashes down around them. Our team thinks that we are better at looking at actual cash flows and valuations and determining sound valuations based on those principles. So we look at cash flows through a cycle. We like to see a business that can produce free cash flows, particularly in smalls and micros. There's a lot of startups. And we've just eschewed those names because we wait until they become real businesses that make cash and earnings, and upon that time, we'll think about investing in them. We like low gearing, lowly geared balance sheets. That was unpopular for some time when rates are very cheap, but when rates go up, obviously cost of debt rises a lot and really impacts earnings. And then we're still old-fashioned enough to believe that valuation matters. And so we look at all our stocks and value them on a cash flow basis and try to buy them at a discount to that valuation. And lastly, and importantly, we keep an open mind. We try to keep an open mind. And that means that when things change in small caps, when you change management teams or you sell off an asset, there can be a dramatic shift in that business's possibility, future possibilities. And I liken that to large caps, where if you change a management team at a large cap, it's a massive machine or a massive boat, the Queen Mary, plowing along at 23 knots. You pull the steering wheel one direction, it takes a long time for that direction of ship to change, whereas small caps are more like speedboats. They can be changed direction very quickly. And we do think that small caps and micros are massively under-researched. You tend to find younger analysts covering the sector, fewer analysts covering the sector, and that means that if you do the work on these stocks, you can uncover great opportunities. Now, I'll go from the sort of macro picture to more of the micro. And one good example of that is Domain Holdings versus REA. Most of you will be familiar with both those two websites in Australia. And Domain has massively underperformed, or realestate.com, the large cap, has hugely outperformed its sister Domain. This is the EV to EBIT multiple of Domain versus REA. And you can see it's hugely underperformed REA. And we just draw the parallel that looks very much like the dramatic underperformance of smalls versus large caps. We've recently started buying shares, or bought shares in a position in Domain. It is number 2 in the marketplace, so it's seen as the poor cousin of REA. And but what's interesting about REA and Domain is that the revenue growth rates between the two companies are not that dissimilar. Both are raising prices sort of 10 to 12%. Both are up trading consumers through improving tier ranges, so you get more for more money. Effectively, you get more highlights on the page you're on. And the cash flow conversion chart, which we show in all our presentations on the left here, just shows you that the history of this business is good cash flow converter, solid growth business, and yet has been hugely derated versus REA. So interestingly, it's got about 20% of the revenue of REA in Australia and about 7% of the market cap. So that does give you some sense of how debased that business is versus REA. And that leads me to another name we have in the portfolio, a stock called NZME, which is a Kiwi-listed media company. It's gone through a bit of a rebirth. So it was an old-style, think Fairfax media business. Newspapers. It has the #1 radio station network in New Zealand. And it's migrated readers across from print to digital in a business called OneRoof inside its assets. OneRoof is a bit like Domain was inside Fairfax. So they've migrated people across from paper to the digital business. It's now the #2 website for property in New Zealand and is starting to monetize aggressively those eyeballs. And you can see on the right-hand side here, the revenue growth of OneRoof. It's been pretty steady over the last couple of years, digital being the dark blue bar. So it's been digitizing its revenue stream and raising prices recently. And if that was put on the same, if you get eventually the same commercials in New Zealand as we see in Australia, they could earn on a per capita basis something like $70 million of revenue, whereas they're currently earning just over 20. So we think there's a lot of latent opportunity in OneRoof in NZME. The stock trades at about 4 times EBIT, has almost no gearing, and we think you're getting pretty much that asset for free. So that gives you some sense of how discounted we think the world is, particularly in micro caps versus large caps. We have a team of 9 analysts, or 9 people at Spheria, and we do both domestic and international small caps. And we see a lot of synergies in that. So I touched on realestate.com. You'll be familiar with Hub and Netwealth and all these other names on the right-hand side that are great, iconic Australian companies. And many of them have overseas peers. Most small cap managers in Australia travel overseas, see comps overseas, and we find that having dual coverage enables us to get good insights into businesses. One thing we've learned from this, it won't surprise you, is that there's been a lot of overcrowding into the growthier, high-quality names in Australia. So stocks like, I'm not calling a stock out necessarily in a negative sense, but things like Pro Medicus, which are really high-quality medical imaging business in Australia, strong growth name, but really bid to the moon because there's such a lack of perceived quality growth names in Australia. The thing's trading on 150 times earnings. WiseTech over 100 times. Reece, which is a great plumbing distribution business, is trading on 40 times. If we look internationally for businesses that look fairly proximate in terms of their growth rates, the returns, and the future market opportunity, you can find businesses we think are quite proximate that are trading on anywhere between a quarter and a third of the multiple of Australia. And so we think, therefore, the opportunity set for smalls internationally is even better than the ones domestically. You'll see some other guys later on today talk about global small caps and the outperformance of smalls versus large, but over a very long period of time, it's been a great place to be. They do outperform large caps over many cycles. And just to finish off then, one stock we own in our global fund is a stock called Sapiens. I flagged it earlier on as a comp for WiseTech. It's not exactly the same, but it's a software company that does software for insurance businesses globally. Like most software companies, it's moving to the cloud, so it's SaaSifying the business. Very sticky client base, very low penetration, and yet it's got all the attributes we like. Great free cash flow conversion. You can see it on the top chart there. Almost 100% of its earnings convert to free cash. Return on capital is steady and growing. Balance sheet's net cash. There's strong founder-like CEO management team in the group, and it trades on around 22 times forward earnings for a business that's probably growing revenue 8 to 10%. So you're probably going to see low double-digit earnings growth consistently through a cycle with a business like that. That trades on a multiple that would be probably 2 to 3 times higher were it listed in Australia. So we do see that opportunity to go global as being quite attractive. It'd be remiss of me to be up here and not give you a little advertisement for Spheria. So like many others here, we have got reasonably good track record over time. I think the team's proud of the fact that we do fundamental research. The alpha's pretty good over time, and we do it with a lower risk than many of our peers. So the beta and the volatility of our funds typically track under the index level for both domestic and international funds there. So to kind of wrap up, I think that we're seeing global small caps have massively underperformed large caps. That time frame has been extended, so 2.5 years is a very long time for that gap to exist. And I think they will lead in recovery. So if rates do get cut, which seems likely, despite the fact that our RBA governor is determined not to cut rates, they tend to think in groups. And so if we're seeing rates being cut elsewhere, inflation being under control, it does seem likely to us that rates will be cut eventually, and that will be very positive, we think, as a backdrop for small caps. And then finally, valuations are low, not across the entire sector in small caps, but in certainly pockets, particularly cyclical names, property sector, et cetera, have been really debased. And that typically attracts capital via takeovers or private equity. And so, the market Twin Peaks offer opportunities in small caps. Thanks for your time.